morning, everybody. Welcome to the Applied Financial Planning 2024 Market Outlook. So we're doing things a little bit different this time. We think you're going to enjoy it. We've got a great program for you. And you know, I'm Bill. I founded this back in 1986. So if you like it, it's because I had a lot of great people helping along the way. You know that we start all of our meetings with a prayer. So if you would, put down your coffee cups and let's remember that everything we do is for the glory of Him, not for us. So with that, Father, thank you for this day. Thank you for allowing us to serve your people. Thank you for the technology that we have, that we can record this information and present it to your people. We do pray that you'll give our speakers the words that you would have them to use, the words that you need your people to hear. We ask special blessings, Father, on our first responders, our men and women in uniform. They're sacrificing their lives sometimes for us, and we appreciate that. We pray that you will bring them home safely, whole in body and spirit. We know, Lord, that you said whenever 2 or 3 are gathered together, you'll be with us. So we know you're here today with us, and we thank you and we praise you, and we pray through your name. Amen.
Amen.
Okay. Different that we're doing, as you can tell, we have a little roundtable discussion going this morning, and we're going to meet the rest of the team a little bit later on. So for now, I want to introduce Marcelo and Steve. And Marcelo, tell us a little bit about yourself.
Thanks, Bill. Hi, I'm Marcelo Bernardo, a wealth advisor at Applied Financial Planning. This is my 32nd year in the financial services industry, and it's my 16th year with AFP. I was born in Buenos Aires, Argentina, World Cup champs. Yes. My father decided that we'd have a better life if we moved to the United States, so we moved to Queens, New York. So I spent a few years in New York. And then he decided to move us to Fullerton, California for a better sunny life. And in Fullerton, that's where I became a U.S. citizen, proud U.S. citizen. And I graduated from Cal State Fullerton with a degree in business finance. And then in 2008, I wanted to integrate my faith with my career. So I joined Kingdom Advisors. And at that time, I was listening to the Frank Pastore show on KKLA radio. And that was my first introduction to Bill and Robert Micone. I really enjoy helping clients, especially when they decide either A, that their situation is so complex that they need expert advice, or B, that they'd rather spend their time enjoying life and allowing us to manage their finances. So AFP for our clients is a great fit, and it's a great fit for me.
Thank you, Marcelo. It was interesting that our good friend Frank, who is long since gone to be with the Lord, touched so many lives, including yours, that got you to come and join us. So we appreciate that.
Yes.
And now we'll look towards Steve. And Steve, give us a little bit about your background. How did you get here?
Well, my name is Steve Henningsen, and I joined AFP about a year ago. My career is such that I started out in a small town in northern Illinois, farming community. My dad had a gas station. It was a lot like Mayberry RFT. I got out of high school and I went downstate to Peoria, Illinois, to Bradley University, got an econ and poli-sci degree. And my brother had already gone to school in Colorado, so I decided to move out there and moved out there and had a great situation there. And then about 3 years into it, I was offered a job in Newport Beach, California, and who would turn that down? So I decided to come out to California. Very fortunately, shortly thereafter, I met my wife, Tina. We've been married now 42 years. We have 2 children and 2 grandchildren, and life is wonderful, and we appreciate that. Now, career-wise, I started out in Newport Beach at a company called E.F. Hutton. Maybe some of you remember that. It eventually became Smith Barney after many name changes. I stayed in the same place for 20 years. And then I moved over to the independent world here with Cetera Advisor Networks, who our current broker-dealer is. Along the way, I met Ron Carson, got involved with the Carson process, and I was really happy when AFP moved over to Cetera Advisor Networks and Ron Carson, and I was able to join the office here. And it's a great team. We have a lot of fun. Everybody works hard, and we have very knowledgeable staff. So it's a great place to work.
Well, thank you. We're glad you're here. Okay, you'll be here for a long, long time. So now the question is, who are we? What are we doing? Why are we here? And we started off in 86 with a simple mission statement that our mission was, is, and always will be to help our clients achieve financial independence. And that lasted for quite a long time. And then it dawned on us as we were seeing success with our people that, then what? So we decided that once you achieve financial independence, we had to then go to the next step and find out, well, what is financial significance? And that means different things to different people. And for some people, it's just hanging out with the family. It's taking vacations. For others, it's getting more involved with their church. It's whatever creates significance for that person and that family. That's what we are trying to help them achieve. We do that, really, there's 4 steps in that goal. And the first thing that we do when we meet with people, we have to first help them create and grow their estate, or they can't get to that financial independence. But once we help them create and grow, then you kind of shift the focus, and it's protect and preserve. You don't want to lose it. You don't want to have to go back and make it all over again. So we come up with strategies to help protect and preserve. Then ultimately, we're going into retirement years. That's why we work hard, save hard, invest, so that we can enjoy retirement. And at that point in time, it's how do we take the distributions from our investments in a tax-efficient manner. That lasts throughout the rest of the lifetime. And then what is of equal importance, and sometimes more importance, is how do we distribute the estate at death? How do we do that in a tax-advantaged manner so that the government doesn't rip off, I shouldn't say that, the government doesn't collect an unusually large bounty on the estate. And that's what we're trying to do. That's what the goal. Marcelo, kind of expand on that a little bit.
Well, we have some unique differences here at AFP. We're independent and objective. We decide what strategies will benefit you, not some ivory tower dictating their agenda to us. We're not biased towards any one investment, and we don't have any proprietary products. We research all investments that are available in the investment universe and select the ones that will help achieve your goals. We're also transparent. We hold a fiduciary responsibility to you. We're upfront with our fees, so there's no surprises. We also help with tax planning and preparation. We can prepare your income tax returns, but more importantly, we can proactively seek ways to use tax laws in your favor. We also help with tax integration with investment planning. This is unique because we integrate your tax situation with your investments to get a tax advantage outcome for you. We work here as a team at AFP. We're 5 fiduciary advisors that serve as your personal coach and as a conduit to our entire team. You have a lead advisor that can pull in other members of our team as needed, custom fit to meet your needs. We're proud of our great team. We have wealth advisors, associate advisors, client service associates, office staff, and communication associates, all here to help you achieve your financial goals.
Thanks, Marcelo. That's a lot of information. I'm glad we're recording this so the people can go back and hit the replay button. Steve, share with us some of the other things that you think are important.
You know, and it's a great follow-up to talk about what Marcelo spoke about. We have integrated technology into our services in each of the 5 areas that Marcelo discussed. We have illustration capabilities. For example, we in the beginning of financial planning, we want to see all of your assets, all of the information, your goals, objectives, things of that nature. We pull it all together on a computer program, and we can provide illustrations, proposals to you that relate just to you as far as financial planning. The second part of that is investment management. As Marcelo stated, we also customize a program. We can illustrate it, show it to you. We have capability of once you're a client, you can look at your portfolio from home. So we have a lot of technology working for us. The second aspect, of course, is retirement planning. We want to start early, running proposals to see what you want to do, when you want to do it, if you can do it, what we have to do to change. And then obviously the taxation part of it is very helpful. I didn't realize how important it was to have somebody like Bill in the office as far as taxation. I am in his office every day asking him some question about taxes. It's great to have an expert on staff. And the last thing, as Bill mentioned, is estate planning. And most of our clients have a trust, something I was involved with last year. I had a couple of clients pass on, and their successor trustees didn't necessarily know what to do. So we now really want to have the successor trustee, the son, the daughter, the brother, whoever's involved, we want to get involved with them early so that they don't walk in here cold after something happens to our clients.
That is so, so important. And typically what happens, it seems odd that the parents, or primary client, are usually more than willing to sit down with the kids and say, look, here's what you're going to inherit. Here's how it's supposed to work. Here's who's going to be in charge. And we find, oddly enough, that the children are more resistant, and they seem to have the attitude, if I do this, mom and dad are going to die on me. and if I don't know it, then they're going to live longer. It makes no sense. But it's critical, because if it's not handled properly, the time delays and the expenses of not getting it right are enormous. We mentioned stewardship principles. We mentioned fiduciaries. One of my favorite movies, Ben-Hur. I watch that at least once every year. And there's a scene in there where the steward is talking to Judah Ben-Hur, and he's proud of the fact that he is the steward of the Hur family. We recognize that we are merely stewards. We have stewardship principles. It's not ours. It's for us to try to make the best of what you have so that it achieves your goals. That's what we're all about. And so now we're going to shift focuses here in just a moment, and we're going to bring up Andrea and Sean, and we'll be looking at our outlook for 2024. We think you're going to get a lot of great information, so I encourage you, go grab another cup of coffee, because you're going to be drinking out of a fire hose real soon. So with that, again, I want to thank Steve, Marcelo, thanks for being here. Great information. People are going to learn a lot from this program. So thanks again.
Thanks, Bill.
Welcome back. As I mentioned, these are the times where you get a lot of information quickly. So good news is we're recording this. You can go back and replay it and pick up whatever you might have missed. So now I have the privilege of being with Sean and Andrea. Andrea, give us a little bit about your background and how you got here.
Thank you, Bill. My name is Andrea Graham. I'm a chartered retirement planning counselor. I've been here at Applied Financial Planning now since 2010. I've been a Californian since 2006 when my husband and I moved out from Houston. I've been working as a financial advisor actually since 2001. Started my career out with Ameriprise Financial. That was fortuitous because they really poured a ton of money into my development, good foundation as a financial planner, and love of systems, which has benefited us all here, I think. I was a lacrosse player at the University of Texas, so hook 'em horns. And yeah, I've got two little girls. I live with Chris down in San Clemente. I got two little girls. They're in kindergarten and 4th grade now.
That's terrific.
That's
now,
how I stay busy.
people, you have to understand, Andrea has, in our opinion, produced more financial plans than any other 10 advisors combined. She's an expert at that. We really, really appreciate that expertise because it helps the entire team.
Well, I love it. That's the
thank you for
synergy
that.
we get because I love solving that retirement income puzzle.
And that's why we call her Plandria.
Plandria.
They do call me Plandria. That's true. That
Okay.
is true.
That's true. Well, okay. So, Sean, your turn. Give us a little bit about your
I'm
background.
too old for this. All right, so very quickly, I started down my business path at the University of Pennsylvania, where I received an undergraduate degree in finance from Wharton undergrad. Put that degree to absolutely no use in the back of an F-14 Tomcat for the United States Navy, at which point in time I then went to the UCLA to teach NROTC to finish off my tour of duty with the Navy, and simultaneously got my MBA from the B School, Anderson, at UCLA. Got out into the real world where I was doing advisory work for foundations, endowments, got into M&A for a couple decades, at which point in time I decided to serve people instead of corporations.
Yay for us.
And that's when I met you
Thank
guys. So there you go, done. All right.
Okay, there you go. Short, sweet, to the point. Now, people, if you go to the website, go to the staffing part, you can get a complete bio on all of the team members. So we're just giving you kind of the high point. So with that, let's kind of shift focus now and get into the the financial affairs. Andrew, why don't you start by, we have 23, we're talking about 24, but coming into 23, what was it like? What was the economic conditions back towards the end of 22?
Yeah, thanks, Bill, because I do think it's important to set the stage before we look forward in 2024, is just to remember where we came from going into 2023. So let's go back in our time machine to December 2022. So 2022 was a pretty tough year, if you guys remember. It was one of the challenging years we've seen in the market, one of the most challenging years we've seen in the bond market in probably 40 years. And we were quite defensive. 2022, we were coming off of the S&P was down, 18%. We had the NASDAQ down over 30%. We had the aggregate bond market down over, double-digit loss, down 13%. Mm-hmm. So it was not a pretty picture. We had incredibly low consumer sentiment. Just for some perspective, the consumer sentiment index can run up past 100. In like May of 2020, in the middle of that pandemic, consumer sentiment was about a 72. You flash forward to the end of 2022, it was like a 59. So we felt much worse at the end of 2022 as a nation than we did even in the middle of the pandemic. So we have low consumer sentiment. We've got incredibly high inflation pushing over 8% in 2022. So we came into 2023 pretty defensive. We had a recessionary style portfolio that we felt like was very appropriate, reading the tea leaves with everything that we had going on. We were in contrast a little bit to what the analysts were forecasting for 2023.
Basically what was happening, what a difference a year makes. I mean, you can take a look at the slide and it shows you Sam Bankman-Fried from FTX, how everyone was hailing him as the coming of the next Warren Buffett. You had all these analysts that were calling for economic genocide. I mean, we were heading off of a cliff. They thought the world was coming to an end.
Yeah, I think the Financial Times said something like 85% of economists did expect a recession in 2023. Everybody was kind of
all the brightest folks came out and said, "Oh, the world's coming to an end." So that's kind of the hand we were dealt at the beginning of the year. And
I do think that the cover having Sam Bankman-Fried on the cover is hilarious of Fortune, because just for you guys know, this was the poster boy of crypto. He was the poster boy of crypto, right? And then you flash forward, so here we are going into 2023. He's being touted as the next Warren Buffett. You end 2023 with that guy being convicted of multiple counts of fraud, money laundering. He's doing decades in jail. So talk about a fall from grace.
He's turning
biggest story since Bernie.
But then, guess what Bitcoin did in 2023?
Well, he's making big Bitcoin into little Bitcoin. Is that what it is? No. Club Fed?
Bitcoin did not care about the fall of Sam Bankman-Fried.
But realistically, I mean, even with all that, what a difference a year makes, like I was saying, what happened? The stock market turned out pretty well. There was a huge rally in the final quarter of this particular year. And we did not hit recession throughout all of 2023. So basically, what do we attribute that to? Well, our friends back in Omaha at Carson, they love their charts and they love their cycles. And then what do we start with? It's an election year, so let's go to the election cycle or the presidential cycle.
Why did 2023 turn out so strong? Well, there's all these like maxims of Wall Street, right? These sayings in Wall Street. In fact, Bill, one of your good friends is
one of our friends, the good Dr. Skousen, has a book called Maxims on Wall Street. He updates it every couple of years. It's now about that thick, and it's page by page of these sayings.
These little rules that we have, like, oh, May is not a good month for, sell in May, go away. There's all these little things. And one of those things is that Wall Street loves the third year of a presidential cycle.
And 2023 was no different. Now, everything else aside, if all you're just taking a look at is the calendar and historical numbers, you'll see, and we're kind of in that middle area right now, or the middle to the far right area. We did okay.
Yeah, and in fact, going back to like 1945, the third year of a presidential election cycle has been pretty strong. So I can just put on my rose-colored glasses, right, and check out for the rest of the year, Sean?
I don't know, because if you take a look at the final cycle, it's not nearly as rosy as the third year. The fourth year is also a lag.
fourth year.
The
Let's
fourth
talk
year.
about the fourth year.
Well, but the fourth year, also, our friends at Carson put together a slide that showed the difference between a lame duck president versus a new president. And in the new president cycle, it's always a little bit better. So if we're just to take a look at the tea leaves as they pertain to our current situation, then one may take from that there could be rose-colored glasses on the horizon. However, I think there are a lot of people that are still scratching their chin wondering whether we have a new president or a lame duck president in the White House.
Or both in the same person.
Yeah, both in the same person.
Well, a lot will be determined in the next few months as to that. And I think it's important to note that we know these old rules. We look at the historical context, but we don't make portfolio decisions based on like, oh, this was 2023 was the third year in an election cycle, so let's go stocks and let's go growth. We don't make decisions like that. We actually like to look at fundamentals
Cash everything out and bury it in the backyard.
Yeah, we pull it all apart.
Well,
Yeah.
essentially, as we've said before, as you've said, as we've all said before, we really don't want to keep politics in the portfolio. Now we know and we recognize that a lot of our clients have a specific worldview, many of which we share. However, all that aside, it comes down to data. And when we're taking a look at the data, we have to be basically bipartisan as we dig in. So if we go beyond that and we take a look, all this fun political roller coaster stuff aside, let's step back. Let's take a look at the data. Wouldn't that be refreshing? And take a look what drives the market, what drives the stock value of a company. Well, how about profit? That'd be really great.
Earnings.
Margins. And what we've seen is actually pretty interesting. We've actually seen a nice uptick in margins and in earnings by the
And I
broader
think
S&P market.
this is why Carson was correct in 2023. They were one of the few shops calling for a strong market in 2023. We were doubtful, obviously, in first quarter. We still saw huge inflation and everything, but they were looking at, we had strong corporate balance sheets. We had significant income growth actually coming off of the back of a strong labor market. And then we've got a much deeper than expected excess consumer savings, so a really strong consumer. And it's important to remember that the U.S. economy is like 65 to 70% driven by consumption. It's important that we go out there and sell.
Well, the other factoid is the price earnings ratio, and whether or not that ratio you can have profits steady, but if the market's contracting the PE, the value's dipping, even though the profits are there.
Yeah, I'm glad you brought that up because basically right around 2000, we remember the 2000 time frame when we were at the tech wreck and the bubble was going. The forward-looking PE ratio I know it was just at the turn of 2000, I can't remember the month, but it was about 25 times, which is pretty stiff. At the beginning of 2023, it was at the end of 2022, beginning of 2023, that same forward earnings was about 21 and a half.
So that means that the same earnings we
being
paid
priced
less for.
Yeah,
So
we're
the
being
price
paid
came down.
cheaper.
Okay.
It had come down. But at the end of 2023, the price to earnings ratio was closer to 19 and a half. So it's continuing to come down.
So that's the contraction of the PE, which means the companies are still doing great,
Yep.
but we're not paying as much for the future earnings, so that retards the price increase a bit.
Or analogy I like to use for PE ratios for our audience is a common one you guys would be familiar with in real estate market is price per square foot. What is the price per square foot? And you don't expect that the location and the type of the house will drive those numbers, right? We don't pay the same price per square foot in Beverly Hills that we pay in Irvine, right? Or I guess it's getting close, but right now. But there's differences depending on the market, right? And so I think when we look at the markets, the broad markets, and we're talking about price to earnings ratios, we're looking at, tech stocks and these different sectors and value stocks versus growth stocks, and they all have different expected PE ratios, but that is, when we're looking at these earnings and the prices, that is how we're forecasting whether something is on sale and a good price or if it is expensive.
And as always, we're always considering that average return, right, Bill?
Oh.
We're always looking for that average return of, what is it, 7 to 9%.
Andrea, who was the first financial planner in America? Who do we give that credit to?
Benjamin Franklin.
Exactly, and
It was a
good old
close call
Ben.
between Ben and Robert Mycone.
Although they both had a similar attitude towards certain things, so that was okay. No, Ben said that the problem with averages is you put a man's head in the reefer and his feet in the fire. On average, he's room temperature. There's only one problem: he's dead. So that's the problem with averages, is you can't always look at that as the answer.
And so that brings up a pretty big point that a lot of our clients know about, and it's been widely covered, is that in 2023, despite the fact that the overall market did well, it was based on a narrow group of stocks. Some people call it the Magnificent Seven. Some people just refer to it as a tech-led rally. But realistically, I'd say, according to J.P. Morgan Markets Outlook, there were, at the S&P 500 level, the top 10 names were accountable for approximately 85% of the return of the S&P 500 last year. So again, averages can play games with you. And if you didn't have those names, then you didn't have a super banner year.
Yeah. And I think what was interesting looking at the 2023 performance, certainly coming out of first quarter, what maybe surprised all of us a little bit was the sentiment and the momentum and the excitement around artificial intelligence, which did drive those Magnificent Seven, which drove a lot of the stock market performance in 2023. So this belief that artificial intelligence, we know that between now and 2030, there are going to be major gains in productivity, major changes. We remain optimistic about how these changes are going to impact us here in America. But yeah, I think that also made a big difference to how everything turned out in 2023.
Yeah. So now we're worried about moving forward. Does this rally broaden out? And do the underlying economic conditions, will those promote further market growth? So that kind of leads us into the big R word, recession. Now, according to our friends at Carson, Ryan and Sonu, who lead the research team, they don't see any recession in sight. Ryan and Sonu made the call very early in 2023, even going back to 2022, that they didn't see a recession. And the reason they didn't is built largely on the strength of the personal balance sheet. The personal balance sheet is looking very strong. Disposable income is looking very strong. Growth is looking pretty strong. But what are the problems with that?
Detractors from there.
Well, it's a little bit of deceptive. Yeah, that household net worth is so strong, but part of that is being driven by housing, right? Our housing prices have gone up a lot. And so on the balance sheet, we haven't picked up debt because we're all locked into those low interest mortgages that no one wants to change. But the housing prices have come up. So these strong balance sheets can be a little deceptive because I can't actually break off my shutters of my home and go trade them for groceries, right?
You can't eat the house?
I can't eat the house.
Wow.
And so liquidity. As I said before.
I'm forcing everything in my body to stop from making the Hansel and Gretel witch analogy right now. Anyway, sorry.
Oh, I would love a candy. I wish we could eat the house, but no, it's so I think what's going to happen is, as we said before, so much of the U.S. economy, 65-70% of the U.S. economy is driven by consumption, and so as long as the American households are still healthy and spending, then we look pretty good.
So what are we on the lookout for? I think basically, again, to push these rose-colored glasses off the table as much as we can.
Not allowed to wear rose-colored glasses in the firm. We don't wear them.
Our concerns are about the strength of the consumer. Now, during COVID, we flooded the market with like $2.5 trillion worth of funny money. They came in to try to support the economy and the businesses. And we still have about probably half a trillion that's still floating out there that's making its way through the system. So when that dries up, does the party end, or is it slowly trickling to an end? Well, we're taking a look at credit card balances. We're taking a look at consumer debt. We're taking a look at this
Auto loan defaults, things like that, those can sometimes be leading indicators of whether the economy is strengthening or weakening. So we are seeing credit card debt tick up. We are seeing some auto payment defaults start to tick up.
And it should be noted that those are still below where we were before we got into the pandemic. But our concern will always look at the acceleration. Does it blow through very quickly? Or is it just going to get back to that reversion to the mean?
Is it a canary in the coal mine or not?
Yep. Yeah. So those are, as we're talking about the tea leaves, that's certainly tea leaves we continue to pay close attention to.
So as long as people are still employed, then that means hopefully they're still making payments on those credit cards and on those cards, which kind of leads us to the next topic, is the labor market. Yeah. And the labor market is still strong, and that's a good thing. We still see record low unemployment. We still see strong numbers as far as prime age employable individuals. And it's kind of hard to have a recession when you have a full labor market. But
speaking of that, though,
as Brian Westbury's, I'm sorry.
Well, you talk about Brian in a minute. A lot of families, they're employed, but they're underemployed from the standpoint of what their hourly wage are. And we have families that are now working 2 jobs in order to have the household income to support themselves. So
yeah, it's a great point, Bill. Yeah, because we have to peel apart these charts. It's like these charts come out, but then we really have we really got to dig into it.
Tell us about Brian. He's a good guy.
What about part-time jobs? What about, there's a lot of data in there that we have to break out.
Yeah, and retracting just a little bit. Brian Westbury, he's a notable economist at First Trust. He's on just as many shows, I think, as Ryan is for Carson. He takes a different side of that coin. I mean, he basically says, listen, we haven't had a recession in history that hasn't started with notably low unemployment. As a matter of fact, that's how the recessions generally start. They start off on a peak and then employment falls like a rock. So...
But I think it's this, I think you're right, and I agree with Brian that there's some potential weakness in the system that we really need to keep a close eye on. But I think we should celebrate a little bit the success of American business owners over the last 2 years to survive the effects of inflation, because layoffs are actually really low right now. Layoffs are running around 1%. So the fact that we went into all of this wage growth, that was an impact of inflation. So wages had to rise to keep up with. Usually that leads to layoffs. But employers have really been able to hang on to that workforce, keep layoffs low. So inflation's gone away, right? We don't have a problem with inflation anymore in labor. Where are my rose-colored glasses?
Well, the thing is, I think the other thing is as far as the Bureau of Labor Statistics is concerned, the JOLTS report still says we have, as of the November read, I think we have about 8.8 million jobs still open.
Yeah. Job creation is slowing down, but we've still got, for people that want to work, it looks like the jobs are there.
The jobs are there, and with unemployment, if you do the math, unemployment is a little bit lower than the 8.8 million. And that's a good thing. It's considered unstable when that spread is significantly high, and that's not good for anybody. It's good for job switchers if there are twice as many job openings as there are people available. But for right now, that gap is closing, and I think the Fed actually likes it when there's parity in those numbers, and we're kind of getting closer to that parity. But now we talked about employment. And what's the Fed's mandate, Bill?
2 things: low inflation, stable dollar,
and
low interest rates,
and full
high labor,
high employment.
So let's talk about inflation. And Andrea talked about that for a second. So with inflation, we all know what inflation is. Inflation is, you go to the grocery store and you're freaked out because your eggs are 30% higher. That's inflation.
Costs going up. Things going up.
Yeah,
and the other way saying the value of the dollar going down.
Yeah, it's true. And we had 2022. We had, over 8% inflation. 2023, that number really has come down significantly. You can see on that chart, I think the latest number came in right around 3%. Is that right?
And some of the stickier things in there are going to be housing. The release valve is coming as far as energy is concerned. Energy is kind of helping out inflation decrease. Yesterday, and just for everybody's reference, today is January 27th.
Correct.
And typically we like to put, may I take a minute just to say how much I like this format, by the way? This is something that's reminiscent. I'm tired of just sitting up there doing the slides like I've historically done. This is a little bit reminiscent of our toss arounds, the radio shows that we used to do. Yeah. Anyway, where was I? I was.
Well,
inflation's coming down. It's pushing.
You have to look at. You talked about energy.
Energy, yeah.
Okay, energy spiked, and that drove inflation up. So when energy prices came down, inflation came down, but it came down because of energy prices, not because of general price. Housing didn't go.
Yeah,
Food
and that's
hasn't gone down.
I think that's really important because although inflation has cooled, that's the rate of change. And so what it's not that doesn't mean that prices are coming down. As inflation cools off, that would be deflation, right? We're not dealing with lower prices. We're dealing with just the rate of increase is slowing down. So we're still paying a lot.
The Bureau of Economic Analysis came out yesterday. Like I said, today is January 27th. January 26th, the BEA came out with the PCE for consumption, personal consumption expenditures. That's the one that the Fed actually pays attention to. And I think the core rate came across at 2.6%, which is good. We're getting closer to the 2% that the Fed is targeting. And that is a good sign. So if unemployment remains tight and inflation is coming down, then what does that mean for us? That means that we could be looking towards some rate cuts. But how do we give the Fed license to do that? And that's when we have stability in the markets as far as strong incomes go. Again, it's all about the consumer as far as the Fed is concerned. We're looking at real incomes, we're looking at real expenditures for the consumer. And again, along with that BEA analysis came in a much stronger than expected consumer. Can the consumer keep up with inflation? As far as the numbers are concerned, yeah, we think they can. And what we're talking about is real incomes. Real incomes mean that net of inflation, we're seeing improvements. That means people will continue to be able to pay their bills. That means they'll continue to consume. That means they'll continue to put money away, theoretically.
Yeah.
So that points to a positive outcome for what the Fed is considering.
Yeah, wages have kept up, and people are still spending more money than they do on average. So we're still, I guess, really excited about coming out of the pandemic and having some fun.
And with that price stability, and what we mean by price stability, if you turn on to CNBC, Fox Business, Bloomberg, and you hear about price stability, that just means that you go to the grocery store from week to week, and you're not going to see wild fluctuations as far as prices go. And with that price stability, and with a improved unemployment situation, or at least a stable unemployment situation, that could give the Fed the green light it needs for cuts. Now, are we anticipating massive numbers of cuts? I think there were some analysts out there that were borrowing your glasses that were thinking we're going to have like 25 cuts.
No, 5. I'll bid 6 cuts.
Very aggressive.
And this slide here suggests that there are anywhere from 4 to 5 cuts for 2024. I don't think us around this table think it's going to be nearly as aggressive as that.
Well, it's an election year, and whatever the Fed is going to do, pretty much they have to do by mid-year, because they don't want to have a negative or positive impact on the election. So it won't be long before we find out.
Yeah, but I think, I'm of the mindset that probably we don't see a rate cut before May or June. I think all the action is going to happen in that kind of May, June timeframe, and then really, and to your point, I don't know that they're going to be a little bit handcuffed to make any major decisions without potentially being accused of impacting the election.
But what's the upswing? I mean, what's the upshot of rate cuts? I think that's let's talk about that. Why are rate cuts positive?
Well, if you're a borrower, it's a good thing. What, they peaked close to 8%, now they're down in the 6% range. Go back about 32 months and they were like at 4%. And people buy a home based on the payment, and the payment is in direct relationship to the interest rate. So as rates come down for the same dollar, you can get a bigger loan, means you can pay more for a house. Maybe you can actually afford a home in this high cost environment.
Well, let's talk about the bond math in client portfolios. Basically, we made an adjustment to longer duration in client portfolios, meaning instead of, we lend out the money and you owe it back to us in about a year, year and a half. Now you owe it back to us in, 5, 6, 7 years. What does that mean? That means that in a rate cutting environment, as the rates go down, the actual value of that loan, the value of those fixed income holdings actually improves. So we're investing into that trend right now. Conversely, or not even conversely, complementary,
yes.
complementary
At the same time.
to a lower rate environment. That means that generally growth companies, tech companies, their valuations get improved because they're not putting out all kinds of dividends and they're investing in future cash flows. Those future cash flows are discounted to today's value to present us with a market value of what that company is worth. And if you discount those cash flows at a lower interest rate, the summation of that is significantly higher than it otherwise would be with a high discount rate. So growth companies could be on the rise as well.
And I think people get that, right? Like if you're going to Lowe's and they're offering you 0% financing for like 2 years, maybe you buy something you weren't planning on buying, right? Like these interest rate deals do drive consumption, and it also means some opportunity in the market, which is why we are looking at sectors like small companies, right? So these lower rates are going to help drive the growth of small, medium companies are likely to benefit from that a lot because now their cost of capital is much cheaper to grow. I was looking at the Census Bureau information. The rate of new business applications is one of the highest it's been the last 3 years. The number of new business applications coming in is high. So this low interest rate environment really does bode well for the American entrepreneur.
That's kind of the yin and the yang. Why do we have this growth of entrepreneurialism? And a lot of that go back to the COVID days. So many layoffs occurred. You had a lot of people out of work, and the job market wasn't there in terms of numbers of jobs. So a lot of people said, you know what, I'll put my shingle out there, and if I know a trade, I can have my own plumbing business. I can have my own carpentry business.
Yeah,
And the other aspect is that based on all that money and the cheaper avenues towards financing and cost of capital, companies can reinvest into themselves, meaning CapEx, capital expenditures.
Should I translate CapEx?
Yeah, sure, go ahead.
CapEx are those funds used by companies to acquire, upgrade, maintain their physical assets like their property, the plants, the buildings, the technology, the equipment. So if the company's investing in something that only really has a useful life of like 1 year, that would just be considered an expense. But when they're investing in things like a new roof or opening up a new plant, these are assets that are expected to deliver value in the years to come. That goes on the balance sheet. That's a good kind of spending. And
it increases productivity, efficiency, improves margins and profitability to the company, and accrues to more growth. So that's always a game changer.
Yeah, I think it's going to be great. And we saw productivity surge kind of in the pandemic, kind of after the pandemic, but I think that was really driven by short term where you had a lot of downsizing. So the people left standing there had to do more, right? Mm-hmm. And so but it's short lived. When you have that kind of productivity increase, it's not sustainable. So when we look at now with the impact that artificial intelligence is going to give to employees, where maybe it'll free people up to do more productive things because AI is going to be taking care of some of that.
It allows a business to do more with less.
Correct.
And that's a good thing if you're one of the ones that's employed. And if you're not, then you need to learn a different skill. But with the AI revolution, there's a lot of skills that are being created that we didn't have a decade ago.
I think this is really important too as it relates to what the Fed is going to do, because this environment reminds me a lot of 1995 with Alan Greenspan. And at that time, he made this kind of what was a bold decision to lower rates, even though we had, without the concern of it driving wage inflation, because hoping that the technological advances were going to offset productivity. So I think we're in that same kind of environment now, where we're hoping that the new technology can really help drive productivity and give the Feds that confidence they need to drop rates without worrying about creating wage inflation.
Well, we'll see. The bets are in as far as how many the rate cuts we're going to have. But realistically, there's still a lot of angst out there going into a strange year where we've got wars on a couple different continents. We have presidential changes. We have border issues. We have all kinds of hate and discontent going on right now. And I don't know if you guys are receiving calls from clients who were thinking about, just cashing out, going all cash. It's something that we have to actually talk our clients through on a pretty regular basis.
And it was unusual because typically the bond market is going to outperform cash. We had this window of time where cash was outperforming the bond market. We do think this year the bonds will outperform cash. I think that kind of moment in time has passed. Yeah.
But the thing to remember too here is that what was the name of that study that does fear and greed? The investor study.
Dalbar?
Oh, Dalbar?
Dalbar.
Yeah, Dalbar.
That goes back. They've made that report for at least the last 20 years that I'm aware of, and it's a 20-year look back. So it's over 40 years worth of information that comes forward 1 year each time.
And in every single time, I think the quantitative analysis is that there are essentially two things, and we always talk about this. There are two things that move markets, and we all know it: fear, greed. And fear is, I think, numerically proven by that particular study that fear is 8 times stronger than greed. And that leads people to do very, very odd things. And as this particular chart shows, I mean, it's not timing the market, it's time in the market that makes all the sense in the world. What we try to do on our end here is to allocate smartly for the next 6, 12, 18 months. Whenever we see headwinds coming at us, we try to respond accordingly.
You were in the Navy, weren't you? Did you ever do any sailing?
Oh, yes.
Okay. And if you're going in one direction and the wind's behind you and you're just going to beat the band and you want to turn around, do you turn a 180 and try to go into the wind? No, you tack.
And jibe.
And yeah, and that's kind of what you have us working with on the investments, is it's not a straight line. We have to move and try to find the areas that offer us the opportunity for growth.
Yep.
Yeah, and I think there are, sectors in the economy like energy that are undervalued right now, that have been a top performer but are still a little bit undervalued. So we'll continue to look for those. But yes, there's nothing more dangerous to a portfolio than abandoning this idea of diversification and focusing on one thing. And no one's really good at it. And if anybody tells you they're really good at it, they're lying, because if they were really good at it, they'd be on their private island with their big yacht, and they wouldn't be,
They'd be building a rocket ship to Mars, right?
They wouldn't be sitting with me at In-N-Out. Yeah. Yeah, exactly.
He's doing that.
Well, the volatility is something we always have to deal with, and it's on a regular basis. It's such a regular basis that anytime that there's a 3% swing, that pretty much happens
seven times a year.
Over 7 times a year. A 5% mild correction happens about 3.5 times a year, and so on and so forth. I mean,
and usually at least once a year, it's super normal that at least one time in a year we have a 10% pullback. So at any given moment, we've got a 10% pullback in the market. That's normal. We got lulled. We've had some years like 2017 where we had, no volatility, and we had some really big growth years. So I think people got a little bit used to not having those big ups and downs. And obviously 2022 2023, we're back. But it's normal about every 3 or 4 years to have one of those, a 20% bear market. So in the context of people's retirement, I think it's important to remember we are planning for down years. We know we're not going to get this magic, 7 to 10% average every year. That comes from really hedging the downside and making sure we're positioned to capture the upside and blunt those losses that we might take in those down years. But it's normal to have those ups and downs. That is part of an investor. And
Well,
so to your point.
That's why you set the portfolios up with the 3-year running average. So maybe over a 3-year period, you might hit that average, but not every single year will be 7% or 8% or whatever.
So in rounding this up, and it's been a nice conversation this morning, let's kind of, we've been a little bit all over the place. There's been goods, there's been bads, there's been others that we have to consider. As far as what our clients should expect, looking back historically, we were defensive coming into the year because the market, generally a tech rally, is typically inconsistent with higher interest rates and higher inflation rates and low consumer sentiment. We were a little bit skeptical about the NVIDIA rally and kind of that very narrow rally that happened. We changed our mind after Jerome Powell mid-year decided that he would put a pause on rates, and at that point in time we decided we should rebalance the portfolios, but we waited through that May time frame or the summer time frame because we were waiting for the market to come back to us. So right around the beginning of third quarter or fourth quarter, that's when we started to instigate a new portfolio rotation where we went towards smaller names. We went towards more growthier names. And so far, that's done pretty well for us. I think what we...
And I think it's just interesting to note that the S&P 500 going into October was up like 8% on the year. So between October and December of 2023, it moved, from 8% to ending up, big rally fourth quarter.
Very significant rally, which we participated in nicely. The moving forward, however, I think you'll probably look for a little more rotation. In the October timeframe, I think we had a little bit of international in the portfolio. I think you can look for us to back that out. We'll still maintain a intermediate hold on bonds. And I think we may get into sectors a little more, the little things that we're exploring right now, like cybersecurity, like infrastructure, like AI, and different ways to play both AI and defense could be cybersecurity. So those are the things that you can look for in the portfolio. And I'd suggest anybody who's interested, call your advisor, set up an appointment, and discuss how our strategies are being implemented throughout your portfolio. But other than that, I think that's kind of a wrap on what we needed to talk about. Here are all the additional disclosures. Please, everyone, read them as quickly as you can. And that's it.
There you are. Well, this has been a really unique session. I've had fun listening to you guys. So thank you for all the information.
I've had fun not talking the entire time.
Well, it's easy. This is like literally what we're doing a couple times a week around the table anyway. Yeah. So I'll be very interested in everyone's candid feedback as to whether it's enjoyable to be at the table with us here or should we go back to Alshon?
We mentioned it earlier. If you haven't made an appointment with your advisor yet, get on the phone, get on the calendar, and look at how your portfolio has performed. Look at what we have in there that we expect will do well for you for this next 6, 12, and 18-month period. So with that, thank you for listening. Thank you for being here.
Thank you, Bill.
God bless you all.
Thank you, Andrew.
We'll talk to you soon.